Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
All right, so are you ready to dive into this article about property development loans?
Oh, yeah, I am definitely ready to dig into this one.
Because these are the loans that make those huge projects happen, right?
Yeah, the skyscrapers and the shopping centers and all that.
Exactly. And the goal for us today is to figure out,
Yeah.
what are lenders really looking for before they say yes to one of these huge loans?
Right, because I bet it's a lot more than people think.
And the article definitely makes that point.
Yeah, for sure.
It goes way beyond just the numbers.
Absolutely.
Yeah.
It's a common misconception that lenders only focus on the bottom line.
Yeah, it's just about the money.
Right.
But really they're looking at...
They want to know who they're getting in bed with, essentially.
Oh, wow.
Are these good people?
So it's about the person?
The character? Yeah. And the capacity.
More than just the project.
Exactly. The lender's going to be in a long-term relationship with the developer.
Oh, that's a good way to put it.
So they need to be able to trust that the developer has the experience and the integrity to see the project through.
It's like a marriage.
Kinda.
So you're saying it's not just about having a great business plan.
Yep.
You have to show the lender that you're the right person for the job.
Right. You need to prove you can deliver.
Now, the article talks about the classic 5 C's of credit.
Yeah.
Can you give us a quick breakdown of those?
Oh, absolutely. The 5 C's are character, capacity, cash flow, capital, and collateral.
Okay, so 5 big things.
5 crucial components.
And how do those all play into lending decision?
Each one plays a critical role in the lender's decision-making process.
Gotcha. So let's start with character.
Okay, so character, in lending terms, refers to the borrower's reputation, their integrity, and their track record of fulfilling financial obligations.
So basically, can the lender trust this person?
Exactly. Can they rely on them to keep their promises, especially when things get tough?
Especially when things get tough. That's a good point.
Lenders want to see a history of honesty, responsibility, and ethical behavior.
So it's all about trust.
Trust is paramount, yeah.
And the article said that sometimes a developer with a really good track record could get funding even if their financials aren't perfect.
Right. Sometimes character can actually outweigh a less than perfect balance sheet.
Wow. So it's really they're investing in the person just as much as in the project.
Exactly.
Okay, well, what about capacity then?
So capacity boils down to the borrower's ability to actually repay the loan.
Okay.
So it's all about their financial resources, their experience in managing projects of a similar scale.
Okay, so experience matters.
Experience is key, and also the strength of their development team.
So it's about having the right people.
The right team makes all the difference.
So it's not just about having money, it's about knowing how to use it.
You got it.
And having the right team to get the job done.
Precisely. Lenders look for a proven track record of successful projects, a deep understanding of the local market, and a team of seasoned professionals.
So the team really matters.
It's crucial. For example, a skilled architect
Okay.
and a reliable general contractor can make or break a project.
Those are important roles for sure.
Absolutely essential.
Okay, so cash flow seems pretty straightforward. Lenders just want to make sure the project will actually make enough money to pay back the loan, right?
Lenders will carefully scrutinize cash flow projections,
Okay.
looking for realistic estimates of rental income, operating expenses,
Makes sense.
and something called debt service coverage, which is basically a measure of the project's ability to generate enough cash to cover its debt obligations.
So can the project stand on its own 2 feet financially?
That's what lenders want to see.
Got it. Now what about capital?
Capital refers to the developer's own equity contribution.
Okay, so that's their own money.
Right. The amount of their own money they're willing to put on the line.
So the more they put in, the more confident the lenders are.
It's exactly. A substantial equity contribution is a clear signal to the lender that the developer is deeply committed to the project's success.
So they're sharing in the risk.
They're putting their money where their mouth is.
Because if things go wrong, they'll be the first ones to feel it.
Right. It shows they have skin in the game.
Now, the last C is collateral.
Yes, collateral is essentially the property itself,
Okay.
which acts as security for the loan.
So if the developer can't pay back the loan,
Then the lender can seize the property to recoup their losses.
it's like a safety net for the lender.
Exactly. Collateral provides that security for the lender.
Gotcha. So we've got these 5 C's, and they're all connected.
They're all interconnected.
But the article really seemed to emphasize character and capacity. Why do you think those two are so often overlooked?
You know, it's tempting for lenders to just get fixated on the numbers.
Yeah, the cold hard duh.
Right. They might be blinded by a seemingly lucrative project on paper, but they forget to look at the person behind it.
So they need to look at the who, not just the... Precisely. But isn't character a little subjective?
That's a great question, and you're right, it can be.
Yeah.
So lenders have to be careful to avoid personal biases
Okay.
and rely on objective evidence as much as possible.
So how do they actually measure something like character?
They look for consistent patterns in a developer's behavior, past dealings and relationships. For example, have they been sued or accused of unethical practices?
Okay.
Or do their colleagues and partners describe them as trustworthy?
So it's like a background check.
It's about due diligence.
Okay, so even though character is intangible, lenders are still trying to find concrete ways to measure it.
Absolutely. They're looking for proof, not just promises.
That makes sense. Now, the article also mentions things like legal entities and single-purpose entities.
Yeah.
Can we untangle all of that legal jargon?
Oh, we can definitely try.
Yeah.
It's all about developers structuring their projects in a way that minimizes their personal liability and maximizes tax efficiency.
Okay,
So let's start with the basics. LLCs and LPs.
Okay, so what are those?
LLC stands for Limited Liability Company, and LP stands for Limited Partnership.
Okay.
These are legal structures that act like shields, protecting the individuals involved from personal liability.
So what kind of protection are we talking about?
Protection from personal financial ruin if the project fails.
Okay.
Let's say the project faces a lawsuit or can't repay its debts.
Okay.
In most cases, the personal assets of the developers are protected.
Like their house and their car.
Exactly. Their homes, cars, savings, all of that.
Okay, so it separates their personal finances from the project.
Right. The LLC or LP becomes its own separate legal entity.
Got it. And what about the tax benefits?
Right. LLCs and LPs offer something called pass-through taxation,
Okay.
which means that the profits and losses of the project are passed through to the individual owners and reported on their personal income tax returns.
So no double taxation.
Exactly.
Right.
This can result in significant tax savings for developers, which is why these structures are so popular.
So it's a win-win for the developers.
For the most part, yes.
Now, what about these single-purpose entities?
A single-purpose entity is basically a subsidiary LLC or LP created specifically for a single project.
Okay.
Think of it as a separate container holding all of the project's financial activity.
So it's like keeping everything organized and separate.
Exactly. This separation keeps the project's finances clean, organized, and transparent.
And that makes it easier for the lenders to track everything.
You got it. It also makes it easier for lenders to assess the project's financial health
So it's about minimizing risk
for both the developer and the lender.
and maximizing transparency.
Right. And it signals to lenders that the developer is taking a professional, organized approach to the project.
It shows they're serious.
Exactly. They're not just winging it.
Now, the article also talks about how the risk and reward are shared between partners.
Yes. This could be a big red flag for lenders.
Okay. So,
Lenders pay very close attention to how risk and reward are aligned among project partners. If they see a disconnect, it raises concerns.
can you give us an example?
Sure. Imagine a passive investor. Let's call them the money member.
Okay.
They put up the lion's share of the funding, let's say 90%.
Wow, 90%. That's a lot.
It is. But they end up with a smaller share of the profits than the developer who's actually managing the project.
Wait, so the person putting up most of the money gets a smaller piece of the pie?
That's the potential issue that lenders look out for.
Why would an investor agree to that?
Well, the money member typically receives a guaranteed return on their investment up front, often called a preferential return.
Okay.
This is paid out before any profits are split amongst the partners.
So they get something no matter what.
It's like a safety net.
But it still doesn't seem quite fair.
That's where lenders get concerned. The developer, with a smaller financial stake, might be tempted to take bigger risks knowing the money member is somewhat protected from losses.
So the lender's worried the developer might gamble with the project.
That's a risk they want to avoid.
So they want to make sure everyone's incentives are aligned.
Exactly. They want to see that everyone is motivated to make smart, responsible decisions.
This is really interesting stuff. It seems like there's so much more to these loans than meets the eye.
Absolutely. And we're just getting started.
There are definitely layers to this.
It's a complex world.
Now, the article also talks about a type of developer that makes lenders nervous. The paper tigers?
Ah, yes, the paper tigers. All style and no substance.
Ooh, what are those?
These are the developers who excel at presentations and storytelling. They can weave a compelling narrative, but when you look closer, their track records just don't measure up.
So they talk a big game but can't back it up.
Right. They might have grand visions and impressive connections, but lack concrete accomplishment.
It's all smoke and mirrors.
You got it.
So how can lenders spot these paper tigers?
Lenders are getting pretty good at seeing through the facade.
Okay.
They scrutinize a developer's history, looking for tangible evidence of success. Completed projects, satisfied investors, a track record of delivering on promises.
So it's all about looking at their past performance.
Exactly.
Yeah.
Actions speak louder than words, especially in the world of property development.
It's about walking the walk, not just talking the talk.
Absolutely.
Now, something else that stood out to me in the article was the importance of the political landscape. Because developing property isn't just about building, it's about building relationships.
That's a crucial insight.
With the community and with the local government.
Right. Property development is deeply intertwined with local politics, especially when it comes to things like zoning regulations, permits, and community approvals.
So developers need to be politically savvy.
It's essential. They need to understand the local power dynamics and build relationships with key decision makers.
So it's about knowing how to play the game.
To a certain extent, yes.
And the article said that if a developer isn't familiar with a particular area, they should really get help from someone local.
Absolutely. Navigating the intricacies of local politics and regulations can be a minefield for outsiders.
Yeah, I can see that.
Partnering with experienced local advisors can be the difference between securing approvals smoothly and facing costly delays or even rejections.
So you need to know the lay of the land.
Literally and figuratively.
Now, we've been talking a lot about capacity.
Yeah.
And the article said that if a developer's juggling too many projects,
Oh, yeah.
that can be a red flag for lenders.
It's a big one.
Is it a matter of spreading themselves too thin?
That's exactly it. Lenders get worried when developers take on too much because it can lead to mismanagement, missed deadlines, and budget overruns.
So it can really impact the project?
Absolutely.
They want to see that the developer can focus.
They prefer a focused approach where the developer can dedicate adequate time and attention to each project.
Quality over quantity.
Precisely. And remember, it's not just about the developer's individual capacity.
Right.
It's about the capacity of their entire team.
Right. The article also talked about the architect and the general contractor.
Absolutely. Lenders carefully assess the experience and track record of the entire team.
So it's about the whole team, not just the developer.
The whole team needs to be strong.
Makes sense.
Yeah.
So we're really starting to see the human side of all of this.
Right. It's about people and partnerships and how all those things contribute to success.
And how those things affect the lender's decision.
Of course, lenders are looking at the big picture.
This is really fascinating stuff.
It is. It's all about understanding the human element.
Well, we're only halfway through this deep dive.
I know, right?
And I feel like I've learned so much already.
We're just getting warmed up.
We'll be back after a quick break to talk more about the financial details and some of those red flags that make lenders say no.
It's going to get even more interesting.
Stay with us. Okay, so we're back, and we've been talking about all the things lenders consider before they give out those huge loans for development projects.
Right. It's not just about the numbers.
And we talked about how important a developer's financial strength is. Yeah. But the article says that lenders look beyond just the balance sheet.
Absolutely. The balance sheet is just a snapshot in time.
Okay.
It shows assets and liabilities, but it doesn't tell the whole story.
So what else are they looking at?
They're digging deeper into cash flow, liquidity, and overall debt levels.
Can you give us an example of what you mean?
Sure, imagine a developer with a high net worth on paper.
Okay.
But all their wealth is tied up in things they can't easily sell.
Ah, so they might look rich but not have much cash on hand.
Exactly. Or they might be buried in debt from other ventures.
So they might struggle to actually pay for the project.
Right, even if they look good on paper.
That makes sense. So lenders are really looking at the whole financial picture.
The whole picture,
Yeah.
yeah. They want to see that the developer has the financial flexibility to handle the inevitable surprises that come with a project of this scale.
Makes sense. Now, the article also mentions some red flags that lenders look out for. Like if someone has a high net worth but low cash flow.
Right, so maybe they have a lot of properties, but they're not generating much income.
So they might not be able to cover their expenses.
Exactly. Or they might have invested in things that are difficult to sell quickly.
So they don't have that liquid cash.
Right.
The article also mentioned overstated property values
Oh, yeah, that's a big one.
and hidden liabilities.
Lenders are like financial detectives.
They're trying to uncover all the secrets.
They have to be. They're looking for any inconsistencies or red flags that might indicate inflated financial strength.
So they're not just taking the developer's word for it.
They're doing their due diligence.
Gotcha. It's all about trust.
Absolutely. Trust is essential in any financial relationship.
Okay, so let's talk about equity.
Okay.
The article emphasized how much skin in the game the developer has.
Equity is huge for lenders.
Why is that?
It shows commitment.
Okay.
It demonstrates that the developer believes in the project enough to risk their own capital.
So it's not just other people's money.
Right, they're putting their own money on the line.
But the article also cautioned against developers overvaluing land as their equity contribution.
Yeah, that's a common tactic.
How does that work?
So let's say a developer bought a piece of land for $1 million a few years ago,
Okay.
and now the market's booming. They might claim the land is now worth $5 million.
Okay.
And use that inflated value as their equity stake.
So it's not real money yet.
Right, it's just a paper profit.
And lenders aren't fooled by that.
No, they want to see cold, hard cash invested, not just unrealized gains on paper.
Because the market could change.
Exactly. Real estate markets can be volatile.
And then the developer's equity would disappear.
That's the risk.
Now, what about those phantom equity contributions?
Oh, those are tricky.
What are those?
So imagine a broker who, instead of receiving their commission up front,
Okay.
decides to take an equity stake in the project.
Okay.
That future equity stake is counted as part of the developer's contribution.
Even though no money has actually changed hands.
Exactly. It's like getting paid in IOUs.
Which isn't very reassuring for the lender.
It's a red flag.
Because what if the project doesn't make enough money?
Then the broker doesn't get paid, and the project ends up with less capital to work with.
So everyone loses.
It's a risky situation.
It seems like lenders have to think about all these different angles.
They have to be strategic.
Now, something I didn't expect the article to mention
What's that?
was the developer's health.
Oh, yeah.
That seems kind of personal.
It might seem surprising, but it makes sense when you think about it.
Okay, why?
These projects often take years to complete, and a developer's health can have a big impact on the project's progress.
I guess so.
What if the developer gets sick or can't continue working?
Yeah, that would cause problems.
You create delays and throw the whole project off track.
So are lenders asking developers for their medical records?
Not exactly.
Okay.
It's more about assessing their overall well-being
Okay.
and looking for potential risks.
Like, do they have a healthy lifestyle?
Right. Are they taking care of themselves? Do they have any health conditions that could affect their work?
Makes sense. And the article also mentioned a succession plan.
That's a key part of it.
What does that mean?
It means having someone else ready to step in if the primary developer can't continue.
So someone to take over the project?
Exactly. This gives the lender peace of mind knowing that the project won't be derailed by an unexpected health crisis.
It's like having an understudy ready to go.
Precisely. You want to make sure the show can go on.
So it's not just about the developer's individual health, it's about the continuity of the project.
Exactly.
This is really making me realize how much lenders consider.
It's a lot to think about.
It's not just about the money, it's about the people and the risks and the long-term vision.
The whole picture.
Okay, so let's talk more about character.
Right.
Because it's so important, but it's also hard to define.
Yeah, how do you measure something like that?
Exactly.
Well, lenders have become pretty good at spotting clues.
Okay, what kind of clues?
They pay attention to how the developer communicates,
Mm-hmm.
how they handle challenges, how they interact with others.
So it's about their personality and how they behave.
Exactly. They're looking for consistency, transparency, and a genuine commitment to ethical behavior.
And what are some red flags?
If someone has a reputation for being difficult to work with,
Okay.
or if they've cut corners in the past or broken promises,
So it's about their past behavior.
right past behavior can be a good predictor of future behavior.
Makes sense. The article mentioned that lenders don't like developers who are labeled as greedy or difficult.
Those are big red flags.
Why is that?
Because those traits can create problems.
Okay.
They can lead to conflict and mistrust and ultimately risk for the project.
So it's about the potential for problems down the road.
Exactly.
And the article listed some other negative labels, like cheap and egotistical, stubborn, unfocused, unable to expedite things.
Those are all warning signs.
Authority rejecting and secretive.
It's a long list. But these are all traits that lenders try to avoid.
Because they suggest potential problems with communication and collaboration.
Exactly. Lenders want to work with developers who are open to feedback,
Okay.
willing to compromise, and committed to finding solutions that benefit everyone involved.
So it's about more than just skills and experience.
It's about emotional intelligence,
Being able to work with others.
building trust, navigating complex relationships.
This is giving me a whole new appreciation for what lenders go through.
It's a lot more than just looking at numbers.
It's about understanding the people and the dynamics of the whole project.
Absolutely.
We've covered so much ground already,
We have.
but there's still more to discuss.
There's always more to learn.
After a quick break, we'll wrap up this deep dive with some final insights and some thought-provoking questions for you to consider.
Sounds good.
Okay, so we're back. And we've been talking all about what lenders look for when they're deciding whether to finance those big property developments.
Yeah, it's a lot more than just looking at a spreadsheet.
For sure. So let's try to sum up some of the key takeaways.
All right.
Like if you're a developer trying to get one of these loans,
Right.
what are the most important things to keep in mind?
Well, I think the biggest takeaway is that lenders are looking beyond the financials.
Okay.
They want to know about your character, your experience, your team.
It's a whole package.
Yeah, they're evaluating you as much as they're evaluating the project itself.
So it's almost like they're investing in the people.
Exactly. They want to make sure they're partnering with someone they can trust.
Someone who's going to get the job done.
Right. Someone with a proven track record.
And a solid team.
A strong team is essential.
Yeah, the article really emphasized that.
Lenders want to see that you have the right people in place.
And they also want to see that everyone's incentives are aligned.
Yeah, we talked about that earlier.
Like with the money member and the developer, lenders want to make sure everyone's on the same page.
Working towards the same goals.
And that no one's taking unnecessary risks.
Right. It's all about managing risk.
And we also talked about how lenders are really focusing on cash flow and liquidity.
Yeah, that's essential.
It's not enough to just have assets.
You need to be able to access that cash when you need it.
Right. You need financial flexibility.
Absolutely. Lenders want to see that you can handle unexpected expenses and keep the project moving forward.
And of course, equity is huge.
Equity is a big signal of commitment.
The more the better.
The more skin in the game you have, the more confident the lender will be.
And remember, lenders are going to be wary of inflated land values.
Oh, yeah, don't try to pull a fast one on them.
Or phantom equity.
They'll see right through it.
So it's important to be upfront and honest.
Transparency is key.
Lenders want to work with developers who are straightforward and transparent.
Right. It's all about building trust.
Now, we also talked about legal structures
Like LLCs and LPs.
and single-purpose entities
These are all ways to protect both the developer and the lender.
by keeping everything organized and transparent.
Right. It's about having a system in place.
And a succession plan.
Yeah. Ah, yes, the succession plan.
Lenders want to know that the project can continue, even if something happens to the key people involved.
It's about ensuring the long-term success of the project.
So this has been a really eye-opening deep dive.
Yeah, we've covered a lot of ground.
It's clear that getting a property development loan,
It's not easy.
it takes a lot more than just having a good idea.
You need a solid plan, a strong team, and a deep understanding of all the factors involved.
And I think the most important thing is to remember that it's not just about the numbers.
It's about the people, too.
It's about the relationships and the trust and the shared vision.
Absolutely.
Well, I want to thank you for sharing your expertise with us today.
It's been my pleasure.
And thanks to all of you for listening to this deep dive
We hope you learned something.
into the world of property development loans.
We'll see you next time.
For another fascinating exploration